All right, so let's begin. SEBI has introduced two set of norms of EOPs. Category 1 EOPs can become agents of AMCs and charge transaction fees from them by obtaining license from AMFI. And Category 2 EOPs can become representative of investors and charge them directly by taking a stockbroking license. Also, SEBI has constituted 16 working groups that will suggest measures to work on compliance and costing of various products like mutual fund, REITs, PMS, KYC, etc. Let's understand all of this and let's also know what's in store for investors in this development. I have with me Suresh Sadagopan, founder, Ladder 7 Financial Advisories. Suresh, good evening and welcome to the show. Quite a complicated and technical topic today to help investors and viewers. So let's begin with execution-only platform. Okay, we knew that SEBI was about to come up with some guidelines, and now they have clearly defined both the categories and the kind of work and implementation that they need to take care of. So what exactly has been introduced in terms of norms for both EOP platform? Could you just explain that?
I'll give some background.
Sure.
See, previously there were certain platforms like ET Money and various other platforms like Paytm Money and all that. So they were providing essentially execution services, and they were not really providing any advisory. But still, they were coming. They had to register as investment advisors. So they were coming under IA regulation, but they were actually not providing any advisory services. So this was a regulatory gray area because the clients were actually doing the transactions on that platform. Since they are only doing transactions, they are not taking advice. If there is any problem that they encounter, there is nobody that they can turn to. So now what SEBI has done is that they have introduced a category for execution only clients, and they have come out with the execution only platform, especially in connection with direct plans. Incidentally, ET Money and various other platforms were actually only on direct plans, and they were also not charging anything at all, and they were also not getting any commissions or anything in the past. So now the current execution only platforms is again only for the direct plans, and it does not profess to offer any kind of an advice. So they will not have to register as an RIA. So this is a new digital platform category which SEBI has created. So there are two types of platforms they have created, like you had rightly pointed out in the beginning. One is going to be an agent of the asset management companies. So they will align with the asset management companies. The platform, they will integrate the platform, the asset management companies and the registrar and transfer agents, and they will be charging to the asset management companies, and there is no charge to the client. So this is one kind of platform. And there is another kind of platform. If people are doing some work with a stockbroker and they want to continue that there, and they want to see all the transactions, reflected in their Demat accounts, they can go through a stockbroker. And the stockbroker will put through the transactions and will directly charge a certain fee as specified under the by the stock exchange. By SEBI under this regulation. So these are two different types. In both the cases, you can choose which one you want to do. In both the cases, if there is any onboarding fees, it will not come to the client for them to pay. So more or less, I would say, broadly speaking, there is not going to be any major effect as far as the clients are concerned. This is a real positive for all the digital platforms, erstwhile digital platforms, which did not have any kind of a way to charge any remuneration. So now there is going to be some fee either coming from the AMC or directly going to come through the stock exchange to them. So this is a positive thing from their point of view. And it's a good thing from the point of view of the customers also.
Let's just focus on customers or investors' point of view. What exactly is a takeaway for investors who actually happen to browse a lot on these kind of execution-only platforms?
See, as far as investors are concerned, what they have to understand is that they are being given more and more choices today. So they can go through a mutual fund distributor if they are really interested in some level of say investment assistance and suggestions. They can go to a financial advisor if they really want the full scale advisory, and they will provide that. Now, if they are fairly competent in terms of their own finances, and they are hopeful of doing everything right by themselves, then this execution only platform is a great way. And again, SEBI has given two different options. So I mean, the choices are actually increasing, and without paying a fee to anybody, I mean, without paying any major fee to anybody, one will be able to put through the transactions and hopefully increase what returns they're going to get over a long period of time. So it's a very positive thing.
But Suresh, any transaction fee burden or any kind of fee burden coming on investors? No, na?
So it is a choice of the investor. If they are going through the platform which is aligned to the AMC, that is EOP1, there is not going to be any fee which they have to pay, and even the platform cannot charge any fee to the. I mean, platform is going to charge, but the AMCs cannot increase the expense ratio in the mutual fund. So there is not going to be any significant increase there, or rather, there is not going to be any increase. In execution only platform number 2, where it is going to go through a stockbroker kind of a person, there they are going to directly charge the customer. So it may be a small charge, but it is going to be a one-time charge, right? For whatever transaction they are going to do, it's going to be a one-time charge. So I don't think in the overall scheme of things, if the customer is going to hold on for a long period of time, like say 3-5 years or beyond, that charge is going to anyway impact in the returns, because it is not going to be a yearly charge. It is not going to get added to the TER.
All right, Suresh, I request you to stay on, but there's LTI Mindtree numbers coming up, which we really need to announce. So LTI Mindtree has come out with their Q2 results. The company's revenue has come up at rupees 8,905 crores versus 8,702 crores, which is up by 2.3% quarter on quarter. While if we look at the PAT numbers, numbers have come around 1161 crores versus 1152 crores, which is up by almost 0.8% quarter on quarter. Also, EBIT margin is at 16% versus 16.7% and looks like down by 69 PPS quarter on quarter. So that's the number, or first set of numbers coming in from LTI Mindtree. All right, we move on. And Suresh, as you were just explaining the kind of transaction or any fee burden coming down on investor, I also want to understand the kind of, the main reason why SEBI had to lay down this kind of a framework for execution-only platform. What kind of trouble was the industry facing, or what kind of trouble investors facing? What was the confusion all about? If you could just give us a background on this.
Yeah, so one of the things was SEBI wanted to actually take out advisory from distribution. So that was the intent, and that is why they came up with the IA regulation. Now, this digital platform, they wanted to do the direct plan. So anybody who's doing a direct plan, they automatically came under the IA regulation. But IA regulation was not really very suitable for them, because truly speaking, they were not really giving any real advice. So the point is, they were not charging also for anything, because they were not giving advice. It was kind of used as only an execution platform. So SEBI understood that, number one, they are not able to earn anything from this from their platform, and they may actually start doing something which probably SEBI would want to proscribe. And from the client point of view, also customer point of view, who is doing on that platform, since they are actually not giving advice, though they are coming under IA regulation, nobody can go to SEBI and say that, okay, I have this problem. Even if there is a complaint, they cannot raise the complaint to SEBI, because they are actually not giving advice. And because they have not given advice, there is no complaint that can be raised against these people. Now, so SEBI has thought about this whole thing, and this regulation, in my opinion, is an excellent workaround to all these things. In this thing, the EOPs are going to get a certain amount of revenue. It may be small, but when we talk about the number of transactions which are going to happen maybe on a daily basis or a monthly basis, it can be very significant, and even a small charge will give a viable fee for the viable income for the platform, and they can perform the role of execution-only platforms very well. And from the customer's point of view, they clearly know now there is an execution platform, and they just need to pay a small charge if they want to go through EOP 2 platform, because they want to deal with a stockbroker and they want to deal with a demat account. And if they are not interested in that, they can go through EOP1, which is aligned to the AMC, and they don't have to pay any fees, and it is going to be only direct plans. So there is no confusion at all. In the EOP platform, it is only direct plans, because some platforms, erstwhile platforms, some were regular, some were direct, so there was a bit of confusion. Now it is all direct plans. The clients know that they are being charged the lowest possible expense ratio, and they have two options to choose. I think over a period of time, the options have increased from the client point of view, and I would say it's a very welcome move.
Suresh, with that, thank you so much. Time to wind up this segment, and thank you so much for being on the show and helping our viewers with this. On that note, let's take a quick break. Post that, I'll be joined by Arnav Pandya, who will be talking about how exactly our mutual fund diversified in terms of active mutual fund being diversified on the same pattern as their index or their benchmark. More on this after this break. Welcome back. You're watching The Money Show with me, Kavita Thaplia. SEBI data shows that equity mutual fund deploy close to 64% of their total corpus in just 5 sectors. They are largely skewed towards financial services, which accounts for almost 31% of the total equity mutual fund AUM. Let's understand this data and the kind of strategies active fund managers adopt. I have with me Arnav Pandya, founder Moneyeduschool. Good evening, Arnav, and welcome to The Money Show. So the 5 sectors, namely over here, are financial services, consumer discretionaries, IT, healthcare, industrials, and the rest of the sectors. Now, if talking about the exposure, it's 31%, the highest to financial services, consumer is 10%, IT 9%, and health industrial is almost 6%. Now, talking about a pattern, a lot of similarity is seen when an active fund manager frames their strategy for a particular fund, which resembles a lot with an index or a benchmark. Do you think it's a very common practice, or that is how it is supposed to be?
Good evening, Kavita. So, whenever an active fund manager is managing a portfolio, the benchmark is an important component which will come into play, because while the fund manager is trying to beat the benchmark, because of the manner in which each of the funds are categorized by the definition of which has been laid down by the Securities and Exchange Board of India, plus the fact that you are likely to have the main holdings which are also part of the benchmark. The portfolio in terms of weightages are not very different from what the benchmark is trying to say. Like, for example, see, when you look at the overall exposure in the market, financial services companies have the largest weightage in the BSE 500. So they are nearly 1/3 of the BSE 500 in terms of weightage by market cap. And you can see that fund managers also have bought 31% of their total amount of assets under management invested in this area. So one has to look at this in the fact that within a particular fund, how much is the variation in terms of the fund manager from the benchmark in trying to earn that extra alpha or generate higher returns.
Let's talk more about active strategies. Now, in terms of equity fund managers following the benchmark in order to frame their own strategy, the kind of resemblance that's been seen, is it something that's usually done, or because of the market condition that we are witnessing right now is something that the data is showing?
So what you will see is that, fund managers will add good, strong fundamental companies which are in line with their investment philosophies into the portfolio. Now, it is quite likely that many fund managers end up with similar companies for a similar kind of fund. Like, for example, if you see large cap funds, you will find that many of the top 10 holdings are similar across a wide range of actively managed large cap funds. The differentiator here is what is the kind of weightage that the fund manager is giving to each of these holdings, because the weightage will determine the kind of outperformance or the underperformance that the fund is doing. Like, for example, if a fund manager is slightly more aggressive, they might go up to 8-9% in terms of the weightage to the top holdings in the portfolio. Someone who is more conservative will stop at 5 or 6%. Similarly, it's just not the same name of companies which are there in the portfolio which matters, but how much has been allocated to them, that also will play a role in the kind of performance of the fund. That is why, you might see that even though, say, funds in a particular category are within a range, there are some which have outperformed and some which are lower than what the average would be seen in the category.
This particular diversification is usually for a large cap fund or maybe a flexi cap fund.
No, so if you look at the range of diversification, you will find this diversification across most categories of funds. So flexi cap funds, multi cap funds, mid caps, small cap, all will have a large number of holdings which are adequately diversified. Now, one exception here would be the focus funds, where the mandate itself says that, the portfolio should not have more than 30 companies. So there the fund manager will have concentrated bets which are there in the portfolio. But overall, in terms of diversification, you will find that most fund schemes, especially in the active sector, will have this kind of diversification. Again, some categories might not be as diverse as others. Like I said, focus funds, you might have sector funds which are not adequately diversified, even in terms of the number of holdings within that. So that needs to be taken into consideration.
One more thing, looking at the kind of diversification, what could be the strategy to mitigate risk?
So there are two things that fund managers do in this kind of situation. One is that having a large number of holdings by itself ensures that there is mitigation or reduction in terms of risk. The second is also what I mentioned earlier, which is that if they want to play it safe or rather reduce the risk even further, they will not allocate too much to the top holdings, which means that even if, say, the top holdings are in the range of 4 to 5% in terms of weightage in the portfolio, just outperformance or underperformance by one or two top holdings will still not have a big impact in terms of the overall situation for the fund. So these are the the ways in which fund managers try and ensure that even while by the very basic feature of having multiple holdings, they're diversifying, they are still trying to reduce the risk further, specifically in categories which are more volatile, like mid caps, small caps, where having a lesser number of holdings can lead to huge amount of volatility within the portfolio.
All right. Let's talk about normal diversification that you see across funds. Maybe we can pick up large, mid, and small. And talking about large caps now, since we are seeing them back in flavor, what exactly, how exactly is the diversification and allocation strategy that's been seen by adopted by fund managers normally?
So what you will normally find is that, see, the sectors which have a bigger weightage in the index and that is being tracked. Like, for example, you will find that no matter where you go, the financial services sector will have the highest weight, followed by consumer discretionary and IT, where the weightage is say 1/3 of that of the financials. But one has to look at one more point, that what is included under a particular categorization is also important, because even though you might think that financial services has such a high weightage, financial services is not just a single type of company, because you will find banks, insurance companies, asset management companies, non-banking financial companies, all of them come under financial services. And within each of them, the fund manager is also taking a call in terms of how much allocation is being done within even these kind of subsectors. Like, for example, when you look at banks, the question there is that should they go in for public sector banks or private sector banks? Even within, say, the public sector and the private sector space, how much is being allocated to the large cap banks and how much is going towards the mid cap banks? All these are factors which ensure that even though on an overall level you might think that the number of holdings or in terms of sectors are less, but actually there is diversification within the sector, within the subsector, and even in terms of market cap, which is going on when the fund manager is making the decision.
All right, I think it's a wrap off for this discussion. Thank you so much, Arnav, for being on the show and helping our viewers with this. We'll slip into a quick break, and post that, let's get your mutual fund portfolio queries answered. Welcome Welcome back. You're watching The Money Show with me, Kavita Thapliyal. There are plethora of funds available in the market to invest your hard-earned money in, but how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? To help you navigate through this maze, we have Aditya Shah, founder, Hercules Advisor. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Hi Aditya, good evening to The Money Show. And let's take our first viewer's query, Rahul Sharma. And he's investing 5,000 rupees in SBI Contra Fund, Nippon Small Cap, Nippon Mid Cap, HDFC Flexi Cap, Axis Bank, Axis Small Cap, Bermuda Asset Mid Cap, HDFC Mid Cap Opportunity Fund. And time horizon for this investment is 15 years. And he wants to know if he can generate 3 crores in 15 years. And how much should he be increasing or stepping up his SIP amount every month, or is any shuffling in his fund mix needed? All right. So again, one more question where we see a lot of exposure to mid-cap and small-cap. I think that's a usual case with the investors these days, Aditya. Although it's not wrong to have a higher exposure to this category, but then you also have to make it sure that, you know, it is properly diversified and you have your risk profiling done. Talking about Rahul's portfolio, how much do you have to invest every month to have 3 crores in 15 years? Just a general calculation.
If you want to get 3 crores in 15 years, and I assume a nominal return of about 10%, the SIP of 70,000 has to be done over a period of the next 15 years. That's one part of it. The investor is not doing that kind of an SIP. So I suggest that he steps up the SIP at least by 10% every year and elongates his time horizon, the first point. Second point is, as you correctly said.
So Aditya, what's the CAGR you're expecting on 70K?
10%, ma'am. That's the base return that we expect. 10 to 12% is the return that we expect in our calculations per se, because we assume Nifty has given a return of about 10% since its inception, and that's the base return that we have to assume in all our calculations. The second point is, investor, as you correctly pointed out, ma'am, that all investors are now leaning towards the small and the mid cap space, because the small and the mid cap space has given humongous amounts of return over the last 6 months. However, I would suggest to the investor must risk profile properly, and only after risk profiling properly, the investor should invest in the small and the mid cap space. From the investors' portfolio, I have chosen 3 funds. Those 3 funds are Nippon Small Cap Fund.
And let's talk about the funds, and let's also decide. Let's also look at the kind of funds he needs to first hold on to. So, in which funds you think the investment should continue?
Yeah. So I have chosen 3 funds on this portfolio: the Nippon Small Cap Fund, the Parak Flexi Cap Fund, and HDFC Mid Cap Opportunities Fund. These are the funds in which he's currently investing in, and he has to stop the existing SIPs and continue his SIP into all of these 3 funds. For the existing investments that he has got, he can slowly redeem, and after redeeming them slowly, he can invest in all of these 3 funds, also through an SIP route. Consistent and disciplined investment over the next 10 to 15 years.
So you are recommending him to stay put in Nippon Small Cap, Parak Flexi Cap, Nippon IDFC Mid Cap Opportunity, and HDFC Mid Cap Opportunity also. So these 3 funds basically.
Right, absolutely.
Okay. No large cap exposure needed to balance out.
And we have got a Flexi Cap Fund. A Flexi Cap Fund will make sure that the...
Is it a large cap? Is it a large cap biased Flexi Cap Fund?
Flexi Cap Fund with a large cap bias.
Okay.
The top of it being HDFC Limited, HDFC Bank, which is the which is a top company in this country, together with IBs. So it does have a large cap bias per se. So from that perspective,
why do you want him out of SBI Contra Fund?
Ma'am, the point really is that the investor should not be taking any investments in a contra fund per se at this stage. The investor should be invested in a diversified fund per se. Contra fund is only for those investors who can take very high risk inside their portfolio and can manage the fund.
Exactly, is a contra fund in that case, Aditya? Could you explain the nature of the fund?
Yes. So SBI Contra Fund is generally a fund which is for highly risky investors. What it really does is, if in the market, if you find that there's an opportunity where a company is undergoing a short-term pain and the fund thinks that the pay is temporary in nature, the fund will try to take exposure there. And what will then happen is, over a period of 2 to 3 years, the fund will make good returns. Then over a period of 2 to 3 years, it will not make returns. Then over a period of 2 to 3 years, it will make returns. So these kind of funds have a high cyclicality in their nature of returns, and therefore it is not advisable for any retail investor who is trying to uh, have a long-term exposure to take these kinds of funds. You will have to time your investments in these funds, and timing of investments for retail investors is not desirable. So,
Talking about the mid-cap funds that you recommended, why no to Mirror Asset mid-cap and why yes to HDFC mid-cap opportunity?
recently, ma'am, HDFC Mid-Cap Opportunities Fund has picked up their performance. The performance is going up. Per se, there's no
Here?
sorry.
Are you looking at past performance?
No, the portfolio of the fund is really good at this stage, and the fund managers are doing things where over the next 3 to 4 years, HDFC mid-cap opportunities will have a good track record per se, in my opinion. So I look at the past portfolio as well, past performance as well as the future fund management strategy that a mutual fund is employing. And from that perspective, out of the two mid-cap funds, I wanted to hold one mid-cap fund, and I had chosen the HDFC mid-cap opportunities.
All right. So we move on to our next question, which is from George, and he has Parag Parek Flexi Cap. Aditya, he has Canara Robeco Emerging Equity, he has Axis Mid Cap, and he says that he has SBI Blue Chip, ICICI Pru Blue Chip, DSP Equity Opportunity, Kotak Emerging Equity also. He's been investing since last 5 years, and he wants to continue investing for more 5 years. So overall, it's a 10 years time horizon as far as investment time is concerned. And he also would want to know if any changes that you might want to recommend. So clearly, it's just 10 years time horizon. We really don't have the kind of corpus, the information for the corpus that he wants to accumulate. But looking at the fund mix, he can opt out of few. Would you recommend that?
Yeah, ma'am. So what is really happening is the time horizon is just 5 years time. So risky funds cannot be included in his portfolio. So I've suggested about 5 funds: Parag Parek Flexi Cap Fund, Canara Robeco Emerging Equity Fund, DSP Equity Opportunities Fund, Kotak Emerging Equity Fund, and Axis Mid Cap Fund. But on the Axis Mid Cap Fund, he will have to keep his allocation very low. These are all 5 funds which are existing in his current portfolio, and he should stop the SIPs in all other existing mutual funds. There's no need to go active large cap funds. Large cap funds underperform on the active side of it. These 4 5 funds will do it for them. The flexi cap funds do have large cap bias, so there's no need to add any extra large cap fund person. These 5 funds and Axis Mid Cap Fund cannot have an exposure more than 10% in his portfolio. Existing funds, you stop the SIP and redeem them and go into all of these funds.
Also, Aditya, he's been investing since last 5 years, okay, and now he just has a 5 years time horizon. Do you think he needs to go a little less aggressive?
Yes, and that's he needs to be less aggressive, and that is why I said that the Axis Mid Cap Fund needs to be restricted to just about 10%, 5 to 10% of his investments. All other funds do have some large capish bias or the other inside their portfolio and are diversified completely. So in my opinion, all the other funds should be really okay.
Aditya, more 5 years, and after that he has his financial goal, whatever he's lined up for himself. My question is, do he should be invested for all 5 years, or it should be only till 3 years he should be in equity and then start shifting his entire amount in debt? Because coming out of your funds strategy is also needed as far as your financial portfolio is concerned.
Absolutely. So if he has got a time horizon of about 5 years, by the end of the 3rd year or during the 4th year, he should start doing a systematic withdrawal plan where every month he's pouring out some money from equity side of it. And by the end of the 5th year, he should be completely out of equity. So there has to be a strategy where by the end of 3rd year, you decide that your equity exposure then comes down from about 100% to slowly and steadily to 0% from the end of 3rd year to the end of 5th year. You can do this by a systematic withdrawal plan and park this money up into a debt product, into a debt mutual fund, such as a liquid fund or a short-term debt product. depending on where the interest rate cycle would be 3 to 5 years down the line.
All right, we move on and let's take Lakshmi's question. And Lakshmi says that she's been investing in SBI small cap for at least 1 year, and she wants to know if she can switch in the same category but in a Nippon small cap fund.
Ma'am, so investors are chasing returns, and sometimes the Nippon small cap fund will do well, sometimes the SBI small cap fund will do really well. So investor cannot know per se beforehand which fund will outperform and which one will underperform. In my opinion, if you have got this SBI small cap fund, there is absolutely no need to change per se. First of all, if you have invested in a small cap fund, your time horizon should have been not less than 10 years per se. And you have just started off in the last 1 year. So some bit of outperformance from other funds will be there. There's nothing to worry about per se. Continue with this fund, and even if it underperforms for the next 1.5, 2 years, you have to stick to this fund, because to see some amount of handsome returns over the next 10 years, you have to continue to do your SIP and be very consistent and disciplined. So no to the change and continue with the existing.
All right, we'll take Kamal's question, and he's looking for a corpus of almost 3 to 4 crores. He's 28 years old and he wants to retire by 60, and he's doing some investments. The funds are Axis Blue Chip, Axis Mid Cap, Canara Bank Emerging Equities, SBI Small Cap, Nippon India Flexi Cap. And he also says that he can increase his SIP amount, or whether the amount of corpus he wants to accumulate, the current SIP amount is enough, or he needs to step it up. 28 years old, Kamal, congratulations if you're watching this show. The right age to, actually line up your financial goals and have an investment portfolio laid down. You started your investments also. And one good thing is that the first goal is of retirement, which usually we tell people not to delay on that particular financial goal. But let's look at the fund mix and also the investment amount. Aditya, how practical is he as far as his planning is concerned and the fund choice is concerned?
Given the time horizon of about next 30 years, I think the amount that he's SIPing should be good enough for the goal that he's envisaging. Point number one. Point number two is he's got too many funds inside his portfolio. These funds are not really required per se. So I've shortlisted this to 4 funds. Active blue chip funds are not really required. So UTI Nifty 50 Index Fund, Canara Bank Emerging Equity Fund, SBI Small Cap Fund, and Parag Parek Flexi Cap Fund. Since you are young, try to SIP the small cap fund very, very slowly. Slow and steady in the small cap fund, because small cap valuations are excessive and there could be a correction within the small cap space. So you need to first get attuned to the volatility in that area, and then only you should start off the SIP. So these 4 funds you have to consistently and discipline, and in a disciplined way you have to SIP for the next at least 25 to 30 years, and you will be able to make your goals.
It's very interesting, a 28-year-old to have this kind of a portfolio and the understanding of, diversification that's needed in their financial portfolio and financial planning. But apart from Kamal, for all those first-time investors, what can be an ideal portfolio to begin with if they have the same kind of goal, maybe have 3 crores till, at the age of 60? Also, how practical is Kamal for this retirement goal, 3 crores? Because 3 crores, maybe he's thinking of the present value, and after 60 years, this amount will increase, right? So, what kind of an ideal portfolio would you recommend? How should they align this particular goal as far as retiring at 60 is concerned, the kind of corpus they would need to accumulate at that age?
And once you start off investing, the first thing that you need to do is you need to start off with a large cap fund or large cap index fund would do, and then start off to invest in a flexi cap fund, which is very diversified. So what it really does is it teaches you what is volatility in the market, and these funds are not too volatile per se. So you will go slowly and steadily into the market. Then once you have gathered experience over the period of next 1 or 2 years, then you can slowly and steadily start to dab into the small cap fund and the mid cap funds. So that should be your strategy. Slow and steady investments, slow and steady understanding of the markets, slow and steady understanding of the volatility in the markets, and that's how you should be proceeding. Now, as you correctly said, the investor would have envisaged that he requires 3 crores today, and considering the inflation, that amount will be inflated 4 or 5 times as the inflation comes in. So investors need to really understand whatever amount that they envisage today, it has to be bumped up with respect to the inflation that today currently that we are facing. The inflation today in this country is anywhere between 4 to 10% on general goods, 10 to 14% on the medical inflation, and 10 to 14% on the education inflation that is there. So all of these inflations need to be kept in mind before your financial plan, and the investors need to keep in mind that what is the amount that they will require at the time of their retirement, and then they need to back calculate it, they need to discount it, and see what is the amount that they will require. So net, it is a complex process. It is a process which requires a lot of work. And I will suggest to investors that you should link your investments to goals, and goals which are defined for the next 20 to 30 years with the amount that will be required then, and accordingly they should invest.
Let's move on. And next question is of. Next question we are taking is of Jitendra. He has started investing in Nippon Small Cap and HDFC Multi Cap. He also has Axis Small Cap and SBI Contra. ICICI Pru Small Cap. He wants to generate 2 crores in 15 years, and he wants to know if that's possible. So again, the same set of funds, more leaning towards small cap clearly in this case. So 2 crores in 15 years. Possible for Jitendra?
And if the current SIP that he's really doing, if I assume a 10 to 12% return over the next 15 years, we will see him generate only 1.24 crores, which is short of his amount. So what he needs to really do, he needs to bump up his SIP at least by 10 to 15,000 rupees more every month. That's the first point. The second point is there's a lot of bias towards small cap funds, which is not really required per se at this stage. So what he should be really doing is he should be controlling the risk in his portfolio. He should be sticking to the Nippon Small Cap Fund, HDFC Multi Cap Fund, and he should be also introducing a Flexi Cap Fund, which could be a Parak Flexi Cap Fund or a Canara Robeco Flexi Cap Fund. Again, I want to warn investors that just because in the last 6 to 7 months, small cap funds have given returns, it does not mean that you have to go all out and only invest in the small cap fund. You need to balance out your portfolio. Together with the small cap fund, you need to introduce a flexi cap fund and a large cap fund. The flexi cap fund and large cap funds may not give you that amount of return, but they will be able to control risk on your portfolio. And I will conclude by saying return is something that you see on your portfolio, but risk is something that is invisible. You will only see the risk with these small cap funds once the NAVs are down 20 to 30%, which is very normal. Corrections, up moves are very violent and down moves are also violent. So control the risk on your portfolio and don't lean only towards the small cap.
Aditya, what if one wants to adopt a rebalancing strategy? What if you have a higher exposure in mid cap or small cap? Do you think it's the right time to maybe have a certain amount of that exposure in your large cap category, or you can just continue your investments if you have a longer term horizon or maybe a time horizon of more than 5 years?
I mean, in my opinion, investors should not be overboard on small cap funds right now at this stage. Every time we have seen this valuation gap between the large cap fund and the large caps and the small caps, there has been an inherent correction in the small cap space. So no going overboard on the small cap funds. If you have 60-70% small cap funds inside your portfolio, I will suggest to rebalance your fund and introduce some bit of large cap fund or a flexi cap fund per se. This is the year not to go overboard on the small cap funds. This is the year to chase safety, because with such humongous returns that we've seen on the small cap fund, history has shown that there is a correction. We have already seen that in 2017 when there was a similar move on the small cap space, and 2018-19 we saw humongous correction on the small and the mid cap. So in my opinion, you need to thoroughly see your strategy, see if you are a long-term investor, and compulsorily there should be a flexi cap and a large cap fund to balance the risk that the small cap funds are in.
On to our last question of the day, and this has been sent to us via email just now while watching the show, Aditya. This question is from Dia, and she says that she wants to invest 10,000 rupees in equity mutual funds, and she is 25 years old, and she wants to do an SIP for at least 10 to 15 years, and she wants you to help her out with the fund mix. 10,000 rupees for 10 to 15 years, and she's just 25 years old.
Since you are very, very young, to understand the volatility in the market and to understand how NAVs move, you start off with a large cap fund and a flexi cap fund, which I am telling you, UTI Nifty 50 index fund and the Canara Robeco flexi cap fund. Once you have done an SIP here for the next 6 to 12 months, only then you should start to switch to a small cap fund or a mid cap fund where you have understood the volatility and you are ready to bear that volatility in search of higher returns. You should only go to small and mid cap funds if you have a time horizon of 10 to 15 years. Considering your age, your time horizon should be at least 25 to 30 years since you are very, very young and you have the capability to have that time horizon. So start off with UTI Nifty 50 index fund and Canara Robeco flexi cap fund, and slowly and steadily build exposure into the small cap fund, say a Nippon small cap fund or a SBI small cap.
Thank you so much, Aditya, for being on the show and helping our viewers with their financial portfolio queries. And it's wrap up even on the money show, but I'm going to leave you with a very special segment on the auspicious occasion of Navratri. We at ET Now will make your portfolio shine brighter with top stock recommendations from Sanjeev Bhasin. Listen in to his top stock picks on day 4.
Navratri, a time of celebration, devotion and new beginnings. But this Navratri, we are adding a financial twist to the festivities. Each day of this auspicious Navratri, we are going to make your investment portfolio shine brighter with a special stock pick. With decades of experience, Sanjeev Bhasin has been a guiding light for countless investors, and he is here to unveil his 9 top stock picks, a Navratri gift of financial wisdom for all of us. Thank you so much, Mr. Bhasin, for joining us on ET Now on the special occasion of Navratri. It's day 4 of Navratri and new stock pick coming in from Mr. Bhasin.
Yeah, so my 4th pick is Paytm. Now, arguably, Paytm has become a part of life. You will have to ignore the highs and lows which it saw. 2150 may have been a very, very hugely over premium, and 450 was a very big discount. Its fair value now at this 850, 900 is very attractive. The management itself indicated that China was the front leader in digital, and now they are doing 5 times, India is doing 5 times more digital transactions than China. QR is doing extremely well, and their newly formed NBFC, where they will be doing Kirana lending on the small, retail focus with 5,000 rupees and beyond, is a very big positive. Plus, they have their digital technology and vendors in shape. This stock can hit 1,500 rupees by next Diwali. It's a must-have in your portfolio.
Thank you so much, Mr. Bhasin, for joining us today on ET Now and sharing your top pick for Navratri with all of our viewers. And remember, viewers, 9 days, 9 gems, courtesies Mr. Sanjeev Bhasin. You cannot afford to miss this.